It's good to have a physical event at this scale after 3 years since COVID happened. And today's topic is going to be why investing is not going to be the same as before. And I think that in the last 2 years, the markets have made many dramatic kind of changes. And I think that there are some things that as investors you need to pay more attention to, and how it can actually shape the way that you decide how to invest. Okay? If some of you who have been following me, then you should be seeing some of the videos and some of the insights that I post on social media. So if you have not, you can also head on to either the YouTube or Telegram channel to receive this information. Alright? They are free, don't worry. Okay. So the main message I want to share with you today is that investors can no longer ignore macro. Macro is a big word, but basically it just means that the big picture, the economic conditions, and that would change no matter whether you are a fundamental analysis guy or someone who is using technical analysis to do your trading. This macro factor is increasingly very important, because if you get the macro reading wrong, whatever you do subsequently, right, it's not going to matter. So it's like, you know, when the tide, there's high tide, there's low tide. So it's very important to read the tide correctly before you go out to sail, right? So that macro is the tide, and we need to get that reading right, increasingly important to us. Because you have already felt that central banks and government policy have very huge influence on the markets. What happened when the Federal Reserve raised interest rates? What happened? The market reacts, right? When they cut interest rate, the market also reacts. So government and central bank policies have become very important. And then the second thing is the geopolitical risk. We all know that the China-US tension is increasing. And not only that, we see conflicts like Ukraine, Russia. So I want to give you a very quick update on how then do we handle this, and give you some relationship when some of these macro policies come in, how would it change the markets. So in the last about 14 years, you have seen a very dramatic bull run in the US, and that one of the key reasons was because the Federal Reserve was printing a lot of money. So if you recall, this term called QE, or quantitative easing, is essentially the central bank printing money. So it started in the last financial crisis in 2008. Remember, there was a subprime crisis. A lot of banks were in trouble, and the Federal Reserve wanted to boost the markets, and to create liquidity in the market. So they started printing a lot of money. That was QE1 in November 2008. And when they printed money, they realized that, hey, you actually can solve the problem. Why don't we just print more? There's no consequences yet. So they printed 2010 QE2, 2012 QE3, and then 2020. Do you remember what happened? That was COVID, right? They did the largest ever money printing exercise, and you can see the super spike in QE4. And for all these 10 over years, there was no consequences at all. And the market was very bullish. As you can see, the S&P 500 returned 15.9% per year for that 10 over years where the QE was going on. The normal return, if you take 100 years normal annual return for S&P 500, is just 10.5%. So there was a 50% outperformance per year during the period of QE. So this is what I mean. You cannot ignore macro anymore, because the macro pictures will give you that push to the market, or give you a big drag to the market when it changes. So that is the first thing when we talk about interest rate. Okay? So this is a relationship. A lot of people think that interest rate go up, so what, right? But there is a lot of cascading effects that will cause all the asset classes to change in terms of the relationship to how these interest rate movements. So when interest rate go up, the bond price will fall. Why would the bond price fall? Because they have an inverse relationship. All right. Another way to look at it is that when your bond, let's say when you buy your bond, interest rate is 2%. Then now the bond interest rate go up to 4%. Who wants to buy your 2% bond? Right? In order for you to sell your 2% bond, you have to sell it lower, and that's why bond prices fall. And the second one is growth stocks. When interest rate goes up, the discounting factor for growth stock goes up, which means that the growth stock will be worth less when the interest rate is higher. Okay? So that's why the valuation of growth stocks go down, the share price will plummet. Third, dividend stocks and REITs are also affected, which we saw this year, not this year, last year. REITs didn't have a very good performance, right? A lot of people think that REITs are very safe, but that's only when interest rate is low. When interest rates start to rise, and very quickly, like last year, the REITs get affected. Why? Because let's say again, your Treasury Bill is 4%. Why would people want to take more risk to buy a REIT at 5%? Is that 1% additional justify for the risk that you're taking? Probably not, right? So that is why dividend stock REITs prices will fall as well. And when interest rate goes up, the currency will also strengthen. Why? Because the interest rate goes up, the bank deposits, the fixed deposit, everything looks more attractive. So people exchange for the currency to deposit there, right? Because they earn a higher interest. Then investment yield, we talk about that, it goes up in general, and economy will slow, right? That's why we talk about recession this year. And my view is that recession is very high chance it will happen in the US, and I think it will also happen in Singapore. Okay, because later I'll share with you why. UCurve inversion. And lastly, properties, all this will also come down in prices. Singapore not so affected at this point in time because I think the supply generally is not enough and there's a lot of demand. So property prices here in Singapore are still okay, but in US the property prices have already plummeted already. Okay, so this is why we need to understand macro and how one thing leads to the other things. It's all connected, man. Okay, so sometimes it can be even a related trade. Right, you think that you long the currency and then you short the growth stocks, right? It's actually a same related trade because they are all caused by these interest rate movements. Okay, so that's another thing to watch out for. So application, one application is that you can have forex trades that come out from it from a fundamental perspective. Because in last year, US was raising rates, right? But there were 3 regions that didn't. Europe, Japan, China didn't raise rates. In fact, China was cutting rates. So when that happens, you cause the interest rate differential to widen. When that widens, your USD strengthen, this currency will weaken. So they become a very good forex trade. For example, like this USD JPY, right, dollar yen, you can see that for majority of the year, it was just one direction. Because US keep raising rates, USD strengthen, yen refused to raise rates, so yen continue to weaken. Okay, so it becomes a very, the macro leads on to executable trades. Likewise, this is dollar renminbi, the offshore renminbi. So we can see it's also, likewise, it has a very good strong trend for the forex in the last year. So in fact, if you take a look, the forex were the best trades last year as compared to many other asset classes. As I said, generally stocks, bonds, they don't do well, REITs didn't do well. Even commodities, they only have a very short-lived of run in the first half of 2022. Then after that, the second half of 2022, they also lost that momentum. Alright, so you can see that understanding macro helps you avoid certain risks and help you get onto more profitable trades. And it has got to do with Singapore. Don't think that we are safe, right? Because you'll be thinking, but US is raising rates, Singapore is not, right? But it's not true, okay? Because Singapore, we don't set interest rate. Okay, central banks don't set interest rate here. We use a basket of currency to benchmark the Sing dollar against, and we fight inflation by strengthening the Sing dollar. So when we do that, one of the currency in the basket definitely has to be USD one. And when USD raise the interest rate, USD gets strengthened, and that's where Sing dollar gets strengthened as well, right? In fact, actually Sing dollar strengthened more than USD last year, and that helps us with the inflation. Otherwise, the inflation impact that we feel here will be even more. Okay, so we have no choice but we have to strengthen Sing dollar, and we can do it because we have reserves, right? Because you have no reserve, you can't defend your dollar. Okay, and this is the effect. When we strengthen Sing dollar, the Treasury Bill shot up. Okay, the yield shot up, and you have like the 6-month bill like over 4%. It's pretty unheard of in the last 10 over years, right? So, but that's not say that it never happened before. If some of you who have like lived through the 80s or even the 70s, you probably remember the interest rate in the banks last time, right, was like 5%, 7%. Okay, so I would say that actually in the last 10 over years, the interest rate is not normal. We are now just getting back to the normal period, okay, where we start to see more reasonable interest coming out from it. All right. So what will happen is that bank interest rate has already gone up, and loans have also gone up, right? Which means the cost of borrowing will go up as well. And even from the business side, business tend to slow down as well, and they will be less aggressive. They borrow less because borrowing is expensive, so they don't expand. They put off their expansion plan, and economy slows further, and that's how it leads to recession. And to make things complicated is that if you rely on economic indicators to tell you about the macro, right, you're too slow already. Okay, so the markets actually leads the economic indicator. If you wait until the CPI to come out, right, you are slow by at least a month. okay? Because you only get the last month CPI this month, okay? So it's a lagging indicator. So how do you know where the market is going? You have to look at the markets itself. And if you want to know whether there's a recession, you look at the UCurve inversion, whether there's inversion happening. And the UCurve inversion, it means that your shorter bond yield is yielding higher than your longer bond yield, which should not be the case, right? Because longer bond yield should be higher, right? But it inverts, okay? So when it inverts, the tendency of the recession coming in the next, I don't know how long, next 1 year, next 2 years, 3 years, okay? The timing is not exact, but once the U-curve inverts, as you can see, it goes below the zero line, right? U-curve has already been inverting since last year and is still inverted now, and that shows us that the recession is nearby already. Okay, it's going to happen. All right, but by the time the recession happens, a lot of people will be very scared about stocks, right? They'll say that, wow, recession coming, let's not buy stocks. Actually, it's wrong. Okay, remember, it's complicated, right? Because the economy is not the markets. Okay, so the market leads the economy. And when the market has already gone down in 2022, right, it's a prelude that the economy is going to slow down and the economy is going to go into recession because the U-curve has inverted as well. And the statistics have shown you that recession doesn't mean that it's bad for stocks. It's a coin toss. In the 30 recession in the last 100 over years, right, half of the time you make money, half of the time you lose money. So recession is not a reason for you to avoid the stock market. Okay, remember, they are not in line one. They are always, there's a lagging and then there's a leading indication. And in fact, if the US announced recession, it is the time, your last chance to buy at cheap prices already. Because if you take a look, after the recession has been announced, 1 year, 3 year, 5 year, 10 years later, the amount of chances of your positive returns is very, very high. Okay, so that is one tip for you, right? If the US announced recession officially, it is a time to buy already. It's your last chance already. If you still wait and wait and wait, the boat will leave without you. Alright? So now you understand that understanding macro is a bit more complicated. It's not so straightforward. It has a second order detail that you need to understand. The next thing, let's move to geopolitical issues. And geopolitical tension is going to get worsened, and that's the new normal that we're going to live in. Okay? So we have seen that Russia-Ukraine conflict, and some investors, they like emerging markets. Personally, I think emerging markets generally are not worth the risk, right? For example, Russia halted stock trading. It's still halted now, and there are ETFs that are tracking the Russian index. It's going to be liquidated, and they can't. Even the funds, they can't sell those shares because it is not trading, and which means they are just going to return whatever cash is in the fund. Okay, which means likely the investors will lose more than 90% of their investments. So that's why I think that with geopolitical risk coming up, right, I think emerging markets are actually a very risky time bomb that investor might really consider whether the risk is worth it. Personally, I don't think it's worth it. Okay, so that's why I'm sharing with you. All right. And another application of reading the macro, you know that Russia and Ukraine are major wheat exporter, right, among other commodities. So they are like 20 and 10%, which means 1/3 of the global wheat supply is contributed by them. And one way, the trade idea is to long wheat. Okay, so maybe you think that wheat, but it's very complicated, must go into the futures markets, right? But actually you don't need. In the ETF, there are a lot of all these commodities as well. There's actually a wheat ETF that you can easily buy just using your normal brokerage, right? Including FSMOne as well. Okay. But more importantly, the geopolitical tension that we're talking about is definitely US and China. Okay? And the thing is that the world can never accommodate two superpowers peacefully. Alright? It cannot one. Okay? In Chinese, there's a saying, right? One mountain cannot have two tigers. Okay? So unfortunately, this has happened. China has gained that status and is no longer second fiddle to US, right? It's almost like fighting on par, and US now is very uptight about China. It's obsessed about China. Almost every piece of the media that we read is like, wow, China is doing this, China is doing that. Okay, the Western media is obsessed about China. So this geopolitical tension is not going to go away. Probably the next 10, 20 years is going to be like that. Okay, it's going to be the new normal, and we're going to live with this. And Singapore will be caught in between because we want to be friends with everybody. Right? We want to be friends with US, we want to be friends with China. It is not an easy line to toe for the next 10, 20 years. Okay, it's going to get tougher. And you already started to see US policies have denied access to high-end semiconductor when it comes to China, right? They have prevented those semiconductor companies from helping China manufacture those high-end semiconductor stuff, those chips. Okay, it really hurt China a lot. Okay, in this case, and China is not likely to catch up in terms of semiconductor technology in the next, I think, 3 years. Unlikely. Okay, so that really hurt them. And then the second one is the delisting threat of US listed Chinese companies. That has a bit of like the threat has lowered a bit because the accounting has said that okay, maybe they have a clean bill of health, which we will know in a few months' time. So how can we navigate this is that I think something to think about, right? Likely the world will decouple, okay, because US will have their allies, China will have their allies. And we know that in the past 10 years, the theme has been globalization. Now we are going to not say deglobalization, but decoupling between the two superpowers. And they'll keep forcing countries and companies to take sides. And that means that it might not be safe for you to invest in a company that have both US and China exposure, large US and China exposure. For example, like Tesla, we know that they derive a quarter of their revenue from China. Okay, and if let's say something go wrong, right, China not happy, kick Tesla out, that's 1/4 of revenue gone, right? It is that risky, okay? And semiconductor sector, I think in general is a minefield. Some people will think that, yeah, maybe buy China semiconductor because China government is pushing in a lot of money, right? But I think the progress will be not so smooth sailing and you will take a long time, right, to even see your investment return. So I think there are some risks geopolitically that you must consider. And another thing is that maybe you should, if you want to invest in US company, choose those with little China exposure, like Amazon. They exited China already. So even if China want to bully Amazon, they can't do anything. All right. And on the other hand, if you want to buy China, maybe buy China companies that are listed in China, not listed in the US, and their business mainly they make their revenue in China. Okay, so I do think that are some of the consideration. So in conclusion, I think the macro environment has become tougher, and you should make an effort to really understand two macros that we are talking about today. First is your central bank policies, government policies. Second is that the geopolitical risks that you must also consider. These are the two main things before you think about your other investments, right? You should take note of. And even though I say macro is important, right, that's not the only thing you look at. You still should continue with your fundamental analysis or your technical analysis that you have been doing for yourself. Okay, so with that, I end it here. And if you want more, you can follow me on YouTube or Telegram, right? The handles are there. Thank you very much.